Welcome back to Mysteel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. The oil market is in the midst of a seismic shift. The United Arab Emirates, OPEC's third largest producer, has announced its exit from the OPEC Plus alliance, effective May 1st, with plans to ramp up its own production. This move, coming amid the ongoing Strait of Hormuz crisis, has sent shockwaves through the market, fundamentally challenging our understanding of global oil supply management. To decipher what this truly means, we are once again joined by our Chief Consultant of Energy Policies, Liao Na. Welcome.
Thank you. It's a pivotal moment indeed.
Let's get straight to the core. Why now? The UAE's discontent has been discussed since 2021. What made this the moment to act?
The timing is the result of three converging forces. We can summarize it as long-term strategic divergence is the foundation, the Strait crisis is the catalyst, and the recent Eastern journey was the final confirmation. First, the root cause is a fundamental south-north strategic misalignment with the OPEC core, particularly Saudi Arabia. Saudi Arabia's Vision 2030 relies on OPEC plus production cuts to maintain high oil prices, buying time and funds for its transition. The UAE's strategy is one of aggressive economic transformation. It aims to use the current high prosperity cycle to accelerate monetization of its hydrocarbon resources and build capital for a post-oil future. It has committed tens of billions of dollars in upstream investment, according to its stated plans targeting 5 million barrels per day by 2027. For years, however, OPEC plus quotas have been viewed as a stumbling block, preventing the UAE from fully utilizing this expanding capacity.
And what removed the previous barriers to exiting?
This is where the Strait of Hormuz crisis acted as the perfect catalyst. Previously, the UAE had two major concerns. First, that going solo would crash prices and hurt its own revenue. Second, that it would damage its security cooperation with regional allies and the US. The crisis recalibrated that risk equation entirely. First, the price concern vanished. In a market gripped by shortage fears and high prices, exiting and increasing output is now seen by many as a potential market stabilizing move, a relief to thirsty Asian and global buyers rather than a purely bearish signal. Second, the security calculus was rewritten. The UAE suffered significant damage in this crisis. Its search for unified GCC support met with a relatively neutral stance, leaving it exposed. This highlighted the perceived risk of relying on a single traditional security pillar, accelerating its drive for diversified strategic partnerships. In a crisis of national development and security, the weight of traditional diplomatic risks appears to have dramatically decreased.
So, the Crown Prince's recent Eastern journey provided the final piece?
Precisely, it provided the ultimate resolve and backing. This high-profile visit was far from ordinary. We assess that it likely secured critical strategic understandings with Eastern partners regarding energy security, investment guarantees, and political support. With this kind of reassurance from a major buyer market, announcing the OPEC plus exit immediately upon returning home became a logical, secured move. The timing seems sudden, but in retrospect, it appears almost inevitable.
What is the actual market impact, both short and long term?
Short term, it acts as an emotional hedge and a cushion against extreme price spikes. The announcement itself shattered the market's faith in OPEC plus unity. Practically, with an estimated spare capacity in the range of 2 million barrels per day, the UAE's pledge to boost output and its pragmatic attempts to export via alternative routes could provide precious psychological relief and some elasticity to a stressed market. Of course, constrained by the capacity of its alternative infrastructure, it likely cannot fully plug the massive gap from the Strait blockade overnight. The immediate physical impact may be limited. The signal it sends is paramount. Long term, this signals a potential paradigm shift in global crude supply. The OPEC plus model of collective supply management is cracking. The future appears to be pointing toward a more diversified, fragmented, and market driven landscape. The exit of a core producer severely weakens the group's internal discipline, raising the risk of a herd effect. As suppliers potentially move from coordination to competition, this could cement long term bearish expectations for prices and significantly boost the bargaining power of buyers, especially major importers.
Speaking of the Strait crisis, what's the status now? Is the worst over?
By our assessment, the worst case scenario, where passage rates could have fallen to 10 to 20%, appears to be behind us. While US Iran talks haven't made substantive progress, the consensus for further escalation has weakened. Our assessment suggests passage rates could recover somewhat in Q2, potentially reaching 40 to 50%, but a swift return to pre conflict normalcy seems unlikely. The market is adapting to what looks like a new no war, no peace normal.
A final question. Does this mean heightened geopolitical risk? Is the oil market's permanent new normal?
It seems increasingly so, and the UAE's exit itself may be a harbinger of a broader trend. It reminds us that in an era of global realignment, traditional alliances and organizations, be it the EU, OPEC, or others, are facing cohesion tests. Nations, especially Asian importers, are prioritizing energy security like never before. This is breeding new strategic relationships. Those who can fastest rebuild trade flows and provide security of supply are likely to win the future. For producers, in an era of growing consensus around a potential supply glut, locking in buyers is becoming more critical than locking in high prices. This is widely seen as the core logic behind Saudi Aramco's investments in Chinese refineries to secure long term guaranteed outlets. China, as the world's top importer, is on a determined energy transition path where total crude imports may peak and slowly decline. In this potentially shrinking buyer's market, whose oil gets used may depend less on mere price and more on comprehensive strategic relationships and security guarantees.
Thank you, Liao Na, for that masterful dissection. The UAE's exit from OPEC Plus is not an isolated event, but the eruption of long-standing strategic tensions, catalyzed by crisis and confirmed by new alliances. It provides short-term psychological relief, but long-term heralds a potentially fragmented, competitive supply landscape, fundamentally reshaping the logic of pricing, power, and partnership in the oil market. For decision-makers navigating this turbulent time and seeking to understand the market signals behind these grand shifts in national strategy, alliance structures, and supply chain resilience, GL Consulting acts as your China decoder. We track these paradigm shifts, turning them into clear, actionable insights. For structured, forward-looking analysis, reach out for a sample of our China Energy Policy Perspective report. Thank you, Liao Na, and thank you to our listeners. We look forward to the next episode.